So good afternoon. I am Margaret Mueller. I'm the president and the CEO of the Executives Club of Chicago. It is my pleasure to welcome you to today's program. We are so excited to be in person. This is a phenomenal room. This is the biggest event we've done in years now. So this is really, really exciting. Thank you all for being here. There are a lot of familiar faces. It's so fun to see you. I'd also like to acknowledge the Exec Club Board of Directors, several of whom are in the room today. Thank you all for your support of the club. I also want to thank all of our members who are in the audience today. Thank you, members, for being here. Thank you for being part of our community. If this is your first time at an Exec Club event and you would like to become a member and join the community, please stop by the membership booth on your way out, and Leslie and the team would be very happy to talk with you. Before we get started, I do want to thank all of the sponsors that make programming at the club possible. A very special thanks to today's presenting sponsor, BMO Harris, and to our featured sponsors, Baker McKenzie, Barilla, CDW, Chicago Cubs, CIBC, Discover, Duchossois Capital Management, Healthcare Services Corporation, Ingredion, JLL, Molex, Northern Trust, Northwestern Medicine, OCC, PNC Bank, PwC, Robinson Resource Group, US Bank, US Cellular, and Victory Park Capital. Thank you so much. As well as our supporting sponsors, Associated Bank, Protiviti, Wells Fargo, and Winston & Strawn. So in just a few moments, we will welcome Michael Miranda, National Head of Investments for BMO US Wealth Management, to say a few words and introduce our speakers. Thank you.
Good afternoon, everyone. My name is Mike Miranda, the National Head of Investments for BMO Harris Bank, and I am thrilled to be here with everyone today in person for the much anticipated Exec Club event. BMO Harris Bank is proud to serve as the presenting sponsor of today's program and of the long-term commitment of the Executives Club to advancing growth and innovation in the Chicagoland area. The U.S. economy has faced extraordinary challenges because of the COVID-19 pandemic. Labor markets, supply chain, and consumer demand are in upheaval. Inflation is at a 30-year high, and businesses nationwide have been forced to adapt. We are facing what some call the Great Resignation. Markets are volatile, and a recession is on top of mind. As a financial institution whose purpose is to boldly grow the good, BMO Harris is focused on deciphering these trends and economic signals so we can help our customers and our corporate clients continue to make real financial progress. I am confident today's conversation will shed new light on these issues and what they mean for the future of Chicago business community and beyond. We are pleased to welcome our esteemed panel. In conversation today, we welcome Imran Qureshi, Head of North America WTW, Mike Stritch, Chief Investment Officer, BMO Harris Bank, and Diane Swank, Chief Economist and Managing Director, Grant Thornton. Please join me in welcoming our moderator and very special guest, Emmy Award-winning journalist and Chief Business, Economics, and Technology Correspondent, ABC News, Rebecca Jarvis. Thank you all for being with us today, and over to Rebecca.
Thank you, Mike. It is great to be here with all of you today in Chicago. This is where I feel like I really grew up. I went to school in Chicago at the University of Chicago. And I have to admit, when I got off the airplane April 27th and looked at the weather app, 38 degrees, I felt very warmly welcomed back to the city. But I am thrilled to be here and thrilled to be here with this distinguished panel. And I think it's, as Mike laid out, a really interesting time for the economy, and a big question hangs over the economy. Where are we? Where are we going? And it's something that Diane and I were just talking about a minute ago. So Diane, let's start with you. Where do we stand? Where are we going?
Well, tomorrow we're going to see the first cut of GDP for the first quarter, and we likely will see a negative print. We'll see the economy probably fell by 0.5%, or at least 0. And that's after a very robust quarter in the fourth quarter. But what we saw was the three pillars of U.S. demand, consumer spending, housing, all cash buyers, not first-time buyers, and business investment were remarkably resilient through what we saw in the first quarter, with 1.7 million jobs being created that helped to keep consumer spending afloat, and the savings amassed through both wealth accumulation, the things we didn't spend on, and stimulus. And all that created a momentum into the first quarter on the domestic side, but the trade deficit just exploded. Imports imploded because the rest of the world was hit harder by the Omicron wave, the war in Ukraine, and the collateral damage of that on so many levels, and also new lockdowns in China, which are fairly draconian. So that combination of events means that we just blew a hole in our economy, but it really sort of is the good, bad, and the ugly. The good is we're resilient. The bad is we're so resilient that it's going to force the Fed to raise rates more aggressively. And I am very worried that we get, when Jay Powell talks about not a soft landing, but a soft-ish landing, that's kind of hard. And the Fed would like to see one job opening per worker seeking a job, like we had in February 2020. Job openings are 60% above where we were at in 2020, and the supply of workers is not 60% above where we're at. So how do you increase the supply and reduce demand? You get an increase in the unemployment rate. So I do worry about the economy hitting a more hard landing by the end of the year. Not a recession in definition. A growth recession is, you might as well call it that. The economy grows so little that it's not enough to keep unemployment down.
And where do you see that, Diane, being felt? At what timeline do you see it being felt, especially when it comes to the labor market?
You know, it's Rebecca, you and I have been through a lot in the last 2 years together, but so forecasting during the financial crisis was like standing on fault lines. You could never get your footing. This is like standing on quicksand. Every time you have a tether out, you get hit by another wave, and then, I'm sorry, war in Ukraine was not on my bingo card. You know, not that you should laugh at that, it's horrible, but my head's in the middle of this stuff every single day. You gotta get some levity, right? But, you know, the timeline of two scenarios, that's all I can do now. And you really start to see the bite of higher interest rates in the second half of the year. This is the most aggressive Fed move since 1994, but it's actually more aggressive than 1994. We're talking about 1.25% rate hikes in 4 months' time in 1994. I remember that. I was an economist back then here in Chicago, and that one of those was an intermediate rate hike. That is, they don't do that anymore. They do intermediate rate, decline. But we're going to do 1.25% in 4 months' time. Plus, we're going to start reducing the Fed's balance sheet. A little late to do it, but that is an unknown. And that is the most rapid tightening of financial conditions and off a lower level. So average mortgage payments year over year are up 42%. You've got a 1% increase in the, as the closing rates, more than that in the overall mortgage rate in March. But between the rise in home values and the rise in mortgage rates off such low levels, a move from 3.1 to 4.1, that's 25%. That's a big change. And so we're also doing off 0, which is different than starting at 3 and going to 6, so, which is what we did in 1994.
There's a lot of obviously ripple effects to all of this. The stock market is one. We're going to come to that in a minute. I want to go to you, Imran, to look at the labor market as it is today, the massive sea change we have seen over these last 2 years. And if you could talk both about what's happened, but also what you see as lasting consequences versus short-term consequences.
Yeah. So there's a lot there. So let me try and unpack a couple of different strands of what you asked. First off, I think leaders have been surprised at the pay increases that they're having to make given the labor environment right now. But what's interesting, despite inflation running at, 8.5%, at least according to our data, at the start of the year, companies were budgeting about 3.4% in salary increases. That's still higher than last year, which was in the 2.8% range, so it's still 20% higher, but less than half of inflation. So why is that happening? There's a couple of things. Corporate salary budgets don't actually reflect entirely inflation. They're more correlated to labor supply and demand. And even pre-pandemic, corporations were actually starting to reflect the realities of the labor demographics. Boomers retiring at significant rates, the Generation Z coming into the workforce, a relatively small generation, not enough to replace those boomers. So we had labor demographics that were impacting budgets, but already being taken into account pre-pandemic. But then you look at the situation now, and if you look at corporate budgets set aside to pay for salary increases, what's happening now is that individuals are changing jobs, and they're commanding higher pay increases. You've got increase in benefit costs, and then you also have new entrants into the labor force in industries as healthcare and technology, where the starting salaries are significantly higher. None of that's been budgeted. So employers are having to spend more than what they originally thought they were going to be budgeting at 3.4%. So that's just the inflation. Then you look at the actual real situation with the Great Resignation. So the Great Resignation, everyone's termed it as such. Yes, it's partly and a large part attributable to factors that were happening pre-pandemic that we talked about, the baby boomers and the Generation Z. But we think we're probably in a situation for the next 10 years, for certain jobs, they're never coming back. Those, in terms of the talent available to fill those jobs, we're not going to be able to find that talent.
Would you mind naming some of those jobs?
Engineers, certain engineering, agile engineers, certain production, those kinds of jobs, they're going to be really hard to fill. And we're going to have to wait until Generation Alpha, and that's the next generation after Generation Z, when they're ready to enter the workforce, who are the children of Generation Y, to be able to fill that gap. But just two other points quickly related to that. You got a demographic that's going on. You also have immigration. Immigration has slowed. And that's partly because of COVID. It's partly because of increased nationalism, not just in this country, but in elsewhere. And then you have labor force participation rates dropping, whether it be around parents choosing to exit the workforce to look after children, or whether it be around just checking out of corporate America and going the entrepreneurial route. But you have all these circumstances exacerbating the Great Resignation. And we can get into what companies are doing to address that later on, but that's certainly what I'm seeing, Diane. I know you were seeing something similar.
Well, there's no question that the demographic issue is one that's so poorly understood. Canada actually last year, in their prime age workforce, on a level basis, this is an economy that's got a population close to that of California, so one fraction of us, their prime age labor force grew on a level basis, not percent, more than our prime age labor force. And that's because they had an immigration policy that turns out they needed also workers of all skills, not just high skills, because now they have a shortage of some other workers, but their immigration policy changed the equation for them relative to us. And that's where a lot of the shortfall is. But I made the point, job openings 60% above February 2020, how can you possibly have supply come up to meet that? And then you have these, mismatch in terms of what our talent pool is. But you're also starting to see now, and this gets into some of the labor market dynamics with the inflation situation, I actually thought it was kind of good that by the fall of 2021, we had 1 million fewer workers working multiple jobs, that wages had risen enough that they could work one full-time job. Since fall of 2021 to March, we've eroded that 1 million in lost labor supply by 500,000, because people have working full-time jobs are now working an extra 8 hours or a part-time job to make ends meet. We're seeing retirees that are retired over 65 unretiring at a higher rate, or exceeded the rate of right before the pandemic, coming back in because they can't afford to make ends meet. And, those kinds of shifts, I think, are also really important in understanding the labor market. And even, I always say, and this gets to the issue too about your young talent pool going forward, there is no good recessions. I always get around a tight labor market, some client will say to me, I just need a good recession to find the workers I need to hire. A good recession means you have no jobs to fill, which is why you have the workers to hire. And that there is no good recession. And that's, I think we're gonna see some real tension as rates rise too. It'd be interesting to get Mike's view on this too, and what kinds of companies are we going to expose that aren't as viable going forward?
We will definitely come back to that. Mike, let's talk about the market. The year is off to an incredibly rocky start. What is your view of equities right now?
Yeah, and I think it's no surprise that given what we just heard, slowing growth, labor force issues, pricing issues, that we've had such turbulence over the past few months. Although if you did take a 50,000-foot view and you kind of step back and you just looked at just a price chart of the S&P 500 or the NASDAQ and you said to yourself, wow, this has been a straight shot up for the last 2 years almost, basically. You would expect some kind of reversion to the mean. So it's not out of the ordinary course that we'd have a bit of a correction, but when you get down to the surface, it's really sort of setting itself up for something that maybe we haven't seen in a while. And a couple of points on that. One would be, since the 1980s, stocks have been quite positively correlated with inflation because it's been an inflation that's been correlated with growth and periods of rising growth. And today we've got kind of this cost push inflation, which we're seeing it in earnings results that are coming out right now, where we are witnessing some margin pressures here, from all-time high levels. But those all-time high levels allowed for all-time high multiples. And if those all-time high levels don't sustain themselves, you have a give back that you have to think about there. So that's one thing to think about in terms of that relationship breakdown. The other is the stock bond relationship. I mean, I can give you comments. I'll talk about what our view on the stock market is, but many of our clients and many people in this room and around the country are opening their first quarter statements are saying, oh my God, my bond portfolio is down 10%. I mean, and equities are down 10%, NASDAQ's down 20%, S&P is down 13%. Everything is down, down, down. Unless you were fortunate enough to be heavily in commodities before the crisis in Europe, you're looking at a pretty bleak first quarter. And I know that many people were not in commodities. And many funds that could be in commodities were not for a number of reasons, environmental or otherwise, just a very under-owned asset class. So it's this idea of what is that inflation picture going to do to equities going forward? Also in a sustained inflationary environment, what does that do to the stock bond portfolio construction methodology that's guided many people for the past several decades and led to great returns? So in a nutshell, though, not surprising, the volatility we've seen for a couple of reasons. One from where we've came from, one for what's going on right now, what's driving this environment. And I think we're in line for more of that in the next few months. I do think there's a silver lining, though, which is, Diane talked about Fed expectation and what's this tightening cycle look like. I think we could be nearing, sort of in the short term at least, peak Fed hawkishness. I mean, the rhetoric is very aggressive. People talking maybe 75 basis points even now instead of 50. And I think you could see as sort of year over year base effects come into play and inflation moderates a bit later in the year with some caveats. China lockdowns is one, additional sort of commodity price pressures could be another caveat. But absent those sort of left tail type of events, you could see inflation start to wane a bit. If growth moderates a bit as well, but doesn't fall off the table, you could see the Fed at least get a little less hawkish. And if the market looks forward 6 to 12 months, maybe it's a bit more of a positive scenario setting up for the back half of the year. So our view is cautious short term, but I think there's an opportunity in the intermediate term, and then we can talk longer term. Because I do think inflation is here at a higher level into this cycle for much longer than people would have expected just 1 or 2 years ago.
I have a question or two questions for the audience. Show of hands, how many people in this audience believe there is a recession risk in the next 12 months, a high recession risk in the next 12 months? Okay, about half the room. How many, raise your hand if you believe inflation has peaked. About 10% at best of this room believes that inflation has peaked. So given that, and given the earnings surprises that we've been seeing, the psychology of all of this is as important as the thing that is happening right now.
Yeah. Yes, and I'm not surprised to see all those hands go up. Maybe I'm a little surprised. I guess that would not be consensus call, but it does speak to, I think, that you witness big volatility in the stock market. You hear a lot of news articles that are going to sort of headline with this recession risk because, as we talked about earlier, people click on that. People want to read about that. It goes into this idea of investor sentiment, which is at a terrible position right now in terms of people are very bearish. Institutional positioning is bearish. We do a lot of metrics on this, investor surveys and the like, very negative on the markets, which, for those that follow the markets, contrarian type of indicator. And that's actually something that even in the short run could suggest that we'd see a little bit of a bounce here given where we've come in the past few days. But it's not surprising, Rebecca, to see that level of pessimism. And paradoxically for the stock market, when everyone's feeling quite negative, that tends to say the market 6 months forward could be in a much better place. So we'll see how that plays out. But that is a very big part of it right now because there is a bit of a feeding frenzy into the negative commentary.
And yet you do have this labor market where there is insatiable demand. I checked into the hotel this morning and it was at full occupancy. You couldn't get a room here if you wanted it. So there still seems to be this engine that continues to roar as far as demand is concerned. Where does that put employers in your mind, Imran?
So this Great Resignation that we talked about previously is causing companies to really think about how they approach talent and labor differently. And I think there are a couple of things that we're seeing with our client base. The first is the intangibles matter. So leadership, culture, the employee experience, purpose-driven work. I had a conversation a couple of weeks ago with a CFO of a large trucking company. And he had somebody in his team and engaged in a discussion around their purpose. And their purpose was simple, to provide for their family. The challenge was they'd moved to an open office environment, so where the individual used to have a cube and a picture of his family and could make the connection every day between his purpose and the work that he was doing was no longer there. So this leader had to find other ways to connect to that individual to his purpose. And so he would do things like invite the employee and their family to his house. He would talk about his own family and use stories to connect to the employee. That's an example of a purpose-driven leader. Those intangibles are going to matter more. So that's one. Secondly, we're seeing companies investing in the pipeline. We talked about the pipeline drying up, so you've got to invest early in the pipeline. That means building relationships with community colleges. That means engaging with organizations like the Posse Foundation. I know Jennifer Tani's here, and Diane, you're connected with Posse. Posse is a great organization that takes potentially talent that exists in our cities and provides opportunities for them to get education at college. That is building the pipeline. When we see that allows us to get ahead of some of the challenges. We're also seeing companies really try and identify new sources of talent. And that's where diversity, equity, inclusion comes in. I had a conversation, this was last year actually, right, a year and a half, right in the throes of COVID. And it was with a senior HR leader at a large manufacturing company. And they had plants across the US, in rural America. And what he was choosing to do as a strategy was to double down on their diversity strategy, not hold back. Just because they couldn't find the talent, they said, we're going to continue to go after our same cohort. They decided deliberately to go after female talent in production roles. And they're starting to see traction. They're going after new sources of talent. We're also seeing companies in the new sources of talent re-looking at some of their offshoring operations that have traditionally looked at repeatable jobs in locations like India, Mexico, Poland, rising education levels in those countries are causing companies to rethink the kind of talent they can access there, no longer at lower levels, but higher levels. And then finally, just around automation. So given some of the talent challenges, looking at automation and robotics and AI and machine learning as ways in which work can get done. And that's all happening now as well.
What happens if it is the less than soft landing and these dynamics, the 1.5 job openings for every job seeker, bonuses, and you mentioned the 3.4% planned wage increases, but they're actually much more significant than that. If it's a hard landing, will job seekers be able to expect these things from their employers? Or will employers be able to turn around and say, look, the world changed?
Yeah, I think you're going to see a shift in balance between the relationship between the employer and the employee. And you're starting to see that now. And if you look at some of the unionization activities taking place in places like Amazon and Starbucks and Apple, those are reflections of the employee either not feeling like they're in a psychologically safe space to be able to express what they want from their relationship with their employer, and that's despite getting increases in minimum wages. So you're going to see organizations say, for us to be able to retain talent, let alone attract new talent, they're going to have to rethink of that relationship differently, creating cultures of psychological safety, doubling down on transformative employee experiences. And I think there's going to be, I think, Diane, I've heard you speak about this before, about how you can tell when there's going to be a recession when customer service improves, right? Because that's like an indicator. It's the same happening on the talent. Right, it's the same happening with the employee. The employee experience from employers, we're seeing that ramping up because the next 10 years, unless you're able to do that, you're going to be short of talent.
Well, and to dovetail up that, the issue is we do have this demographic problem that we're not filling. We don't have a growing prime age labor force. So actually, participation has come back a lot from where it was, and where employment to population ratio is on prime age workers is coming back to where it was fairly rapidly, which is good. But there is still this, there's some, at the University of Chicago, they've been doing a survey since May 2020 of work from home, how that's increasing productivity. Turns out we all devote a third of our time that we're not commuting to more work, so that increases productivity. Not exactly the way an economist thinks about productivity, but this is economists making these surveys. But what struck me in their work was some of their surveys show that, first of all, underrepresented minorities and women with school-age children don't want to come back into the workforce, into an office. They want to stay more remote because either they need the flexibility to care for their children, and they also feel like after they were getting a light shined on them and employers were hearing them, they haven't really moved to listen to them. But also them not being in the office, as people return to the office, they're missing out on opportunities. Mm-hmm. And to the extent that, people who don't feel comfortable in the office environment stay away from the office, that's going to create more inequality and leave more people behind on a talent pool that we desperately need to tap, and it's where the demographics are going. And I was actually, Jennifer's here, Posse Foundation annual meeting last week with her, and one of the points I made was that in that survey, one of the things that was so striking was that they also found that people are most comfortable when 90% of the people working with in person are their same age, their same religion, their same political affiliation, their same race, their same gender. That's not how you make good decisions. But,
so don't bring your whole self to work.
Right. But on the flip side of it, the beauty of it is, the industrial psychologists and what we found on the people who are in diverse groups make better decisions. And we know this slam dunk, you have a more diverse pool of decision makers, you get higher profits, better decision making, better talent pool. We know all of that. It is in that discomfort, if you're in that room and you're uncomfortable because they're not all like you have just raised the level of decision making. And that is something that's just, we've got to lean into. But I think the easy way for employers is to say, well, this gets to be really hard. Diversity, equity, and inclusion, it's, tagline was nice, but it gets to be really hard, especially given the gap between employee preferences right now and employer preferences.
Mike, I know you were going to weigh in, and I want to lean into the idea of what all of this means, especially for commercial real estate, for cities, for metropolises that are really dependent on people coming and going every day as they have for years, but not the last two.
Well, not great, but I'll come back to that in a second because I wanted to jump on Imran's comment about automation, onshoring, reshoring. That's a big theme of ours. It's a big belief for this kind of economic cycle that it's something that really stands out in the U.S. in particular, and frankly in Middle America and the Southeast as well. If you look, we try to track some of this data, and I think over the course of the last year, there was about 800 or so firms that we've identified that either were, expanding production in the U.S. or coming back to the U.S. Fantastic, turn of events for the U.S. given the last 20 years. I think there's a great organization called the Reshoring Institute that tracks a lot of this information, do a lot of seminars and educational videos on it, but I think their estimate was somewhere 250, 300,000 jobs were created as a result of this. Now, it's not the same work that was done 20 years ago when these plants left, because it is more technology heavy and the like, so that labor force pool needs to get retrained there. But it is a big sort of positive, I think, for the U.S. in terms of productivity enhancements and capital spending. It will fluctuate with the economy, as capital spending is always a bit cyclical, but it's still been on a secular uptrend, and we think that will continue. So I think that's a bright spot for the U.S. and for other investment opportunities associated with that automation and those types of things. We did an expose on this a couple of, maybe about a year ago. Actually, we went out and interviewed a bunch of our corporate clients and others. Fascinating stories from folks understanding just how they're able to implement technologies today that 5 years ago, these are smaller businesses, totally out of their reach, right? It used to be only for the Amazons, only for the big, let's say, warehouse companies that could do these robots, that could get better spacing out of their warehouses. And it's made them much more efficient. So the question is going to be, do they keep pushing with investment through kind of a slowdown in the economy? We'll see. Surveys say yes to date, because it's also about getting closer to your customers and everything that's happened over the last year or two with supply chain disruption. So a trend that was already in place has really been exacerbated and accelerated over the past 2 years, and we're excited about that. And where is it happening? Mostly it's happening in those sort of smaller regional towns, which, going back to your question, Rebecca, about sort of commercial real estate and real estate in general, if you think about on the commercial side, but there's a residential play too. Now, we like those, obviously those smaller metropolises for a couple of reasons. One is because we think this reshoring thing is real and there'll be continued investment in those communities from a lot of these companies. But two is people can work from anywhere. It's a lot cheaper to work from some of those places than it may be in the big cities, and people just have a feeling that they want that different lifestyle, and that's where you've seen a lot of the movement in terms of migration as well. So I think that speaks well of those regional type of cities for both residential and commercial real estate, but the big cities are going to face some significant headwinds. So it remains to be seen. I mean, Chicago, case in point, I think there's probably folks in this room that are much more understanding of the Chicago real estate market than I am, but I think last check was 17-18% vacancy in the city center. Not a great place right now. So we have to figure that out as a community. But in the short run, it's probably not, commercial real estate, large metropolises, not a great place to be.
I have another fun set of audience questions. Raise your hand if you currently work from home. Keep your hand raised if you believe that you will continue to work from home. Someone's indecisive over here. Raise your hand if you think you'll still be working from home 3 years from now. Okay. So essentially, the people who are working from home think that they will continue to be working from home. By the way, if you're working from home, raise your hand if you enjoy working from home. That's interesting. I think the consistency there is interesting.
You know, I was having a conversation with some folks beforehand, a recruiting firm, and asked that question about what's this trend and the like, and it was, you know, basically 100% of jobs are essentially kind of, well, not 100% because there's manufacturing jobs and things like that where you have to be, but let's just say in the general kind of services industry where work from home is an option, it's pretty much an option in every posting these days. And if you don't have that option, you either have to pay a lot more money or have some real reason why that is. But the more interesting part I found was, you know, this was, again, anecdotal, let's say a quarter or more, location agnostic. Rewind a couple of years ago and it was almost zero would be the thing. I know for our own business, you know, when I think about our investment team, post in Chicago, now we can't, if we're not finding people, it's like, well, let's post, that job could be kind of filled anywhere, especially if they're doing research and not engaging directly with clients day to day in the area. So I think it's here to stay, but there's downsides to that. Maybe you want to jump on that one, because
No, it's really interesting you said that. There are downsides, and I think a couple of things. One, you mentioned the diverse talent, whether it be people of color, LGBTQ, people with disabilities, parents. There's a preference for balancing being in the office with working from home. So that's a reality. There was also this great podcast I was listening the other day. It was a conversation between Brene Brown and Scott Sonnenschein. And it was about how do you lead in a hybrid work environment with some employees at home and some in the office and switching. And they talked about conflict. And this gets a little bit to Diane's point around how do you engage this workforce that sometimes is diverse, increasingly diverse, that works virtually. But there's this idea of task conflict. So think about debating issues and discussing issues and disagreeing. That's healthy, that's constructive. And that can be done in a virtual environment relatively, not easily, but you can handle that. The other type of conflict is relationship conflict. And so what they were discussing was, well, when task conflict turns into a relationship conflict, you can't easily address that in a virtual environment. You have to address that in person because that's the only way you can build trust. And so we're seeing leaders that are able to navigate this, lead through a hybrid environment, create the pull for virtual workers to at least come in once, could be twice a week, could be once every month, but there has to be some in-person interaction. Because I think our ability to navigate conflict, build trust, and then function as high-performing teams is going to be challenging. So
to add on to that, I mean, we know that the magic of innovation, we know the magic of agglomeration, people of an area being in an area with each other, that there's something that comes out of that. We've studied it. It's part of our economy, and this is derailing some of that. And when it comes to, you know, coming up with actually decision-making and having those more diverse decisions being made, it requires people being in person. It's one of the reasons why some of the tech companies early on in the pandemic went back in because they weren't getting the traction they wanted. And we're watching the numbers, and productivity is now diminishing because of the high turnover rates, because it's really easy to pick people off if they're not engaged and they're working from home because they're interviewing with someone, you know, in between their Zoom calls. That is a really important aspect of what's going on. And, you know, I don't think you can hybrid was already happening. There were, you know, I would go in on Employment Fridays, and on Fridays, most people in my office were gone, and we could roll bowling balls around, and we were the only ones in the office, but we had to be in the office because that's where my studio was, and it was employment day, and I had to talk to Rebecca about the employment day. But, you know, what happens when you're all together, and also the mentoring and the bringing people up. I mean, I have deliberately, through, you know, this period in time, met with my team in the most interesting cold outdoor venues when we had to, at least once a week, because, you know, I need to mentor the younger woman who's on my team so she can grow up and replace me someday. I mean, that's what you want to do. You want to lift them up, and you cannot do that remotely. And in the same way.
Yeah.
And I think that's something that we're going to really struggle with in this next iteration. And that's, it's not just ordering people back to work. That doesn't work either, as we know. But we've got to find a way to get the good part of our humanity, which is that we like to congregate. That's why we're all here right now. Isn't this amazing?
We've talked a lot about the domestic picture. I want to touch on for a minute Ukraine, Russia. We saw oil prices spike. They have come back down, but still are highly elevated. And obviously, they were climbing for a long time before Putin's invasion into Ukraine. We've also seen the major disruptions in China recently from COVID and their zero COVID policies and just this idea that they can shut down entire cities. They can shut down Shanghai. They could shut down Beijing. How does that factor, Mike, into your analysis?
Yeah, well, starting with the kind of commodity story, which, the commodity markets were generally tight before the Ukraine conflict started, and that just exacerbated things. We've seen some oil and some of the industrial commodities come off a bit, but what we haven't seen any really retrenchment is on the agricultural side. So, our view we have put on a commodity position. We didn't have one going into this. I didn't think that there would be actually an invasion, even though they were standing up. We tried to do we have probability models and things like that, and the probabilities didn't suggest that would happen. So we didn't have that position on before, a recommendation before the conflict. And so when we set out to say, do we want to establish something more long-term in client portfolios, again, recommending that, people would say, well, aren't we too late? We have this huge pop, and why would I want to put that on now? Because it's kind of chasing our tail a bit. And so we went around, did a bunch of industry channel checks and the like, and I think the commodity pressures are here for a while, and specifically on the agricultural side, I am very worried about the shortage of fertilizers and the knock-on effects that we'll see into 2023. I was actually talking to a farm analyst yesterday, runs a farming fund, spent 8 years in Ukraine itself, and he was just talking about how difficult it is for them to get anything done, even if they've been able to procure, because they have to ship everything through Poland right now, because it's a big wheat, sunflowers, all that stuff coming out of Ukraine as an example. Leaving the potash and the nitrogen from Russia aside from them, have to switch tracks to these old Soviet era tracks in Poland, and it's not feasible for them to do that, so they're needing to use trucks more than anything, and people will only take cash. It's just impossible to execute any kind of business. So you're looking at that supply kind of really wiped out for the foreseeable future. Then you limit this potash, which is the fertilizer component, which as I understand it, not being a farmer, but there's some residual benefit for a year or so, but after about a year, it loses that out of the soil. And his point yesterday, talking to an individual, was the largest single farmer in the world, which I think is 3 million acres in Brazil, pre-ordered their fertilizer for this growing season and have not received it yet. And so he was saying, well, if that's happening in Brazil to the biggest farmer in the world, what is happening to all these other farmers? And so the knock-on effects, again, from a US perspective, relatively insulated. Canada's a big producer as well. But I think this could, you start to see that if the harvests aren't good. And that's a political destabilization too, right, as people suffer. So there's going to be some turbulence with that. That's all a long way to say we still like commodities, even though they have gone up. So if you take a 12-month plus view, I think we're still going to be dealing with some of this stuff in the future.
I just want to spin off on that a little bit. The issue on oil prices, and it's part of Mike's doing his math. When inflation, if we don't have a doubling of oil prices to 130 from 65 a year ago, you're going to see a slowdown in inflation in April, because April 2020, oil prices actually went negative. Had to pay people to store it because nobody wanted it in April of 2020, and then it went to $65 a barrel in April of 2021. So, you have to double that again to have inflation from the energy component be that large. And that's one of the math things that we're going into that slows down inflation. The shoe to drop on food inflation that's already running at a double-digit rate, that is something I'm very concerned about, and the Fed doesn't have much control over. And it's being affected. China also had a big role in the shortage of fertilizer. But I'm not looking at other issues, and it dovetails on something Mike talked about, reshoring, regionalization of supply chains. That's been picking up since 2010. The pandemic and war in Ukraine just accelerated that. The idea of moving from just-in-time to just-in-case inventories, all of those things, the low-hanging fruit of globalization and the disinflation it created, we're talking about a post-pandemic world that's going to be more boom-bust and inflation-prone with a more activist Fed. Waiting for, it's like we've walked through the looking glass, as Alice did, where the clocks run backwards, but there's no way to wake up from the dream and be on the other side with her cats in her lap again. There's no returning to the world we left. Even the move to endemic means that you're going to have yet another factor that's going to have more people out sick at any point in time, which is more costly and more inflationary. So this world we're talking about going back to a 4-decade deceleration in inflation, that's not there anymore. And that's a very different kind of world. And it gets to one of your issues of asking the audience, what do they expect? People, expectations on inflation matter a lot. And that is something that people are, in the 1970s, bake in cost of living, the CPI. In the 1970s, about 80% of wages were tied to the CPI. I had a mentor that worked at the Fed, and he did that work in the 1970s, and so it was, I just saw him last week, and he was really good at that kind of stuff, but it was, they had a cost of living adjustment, which was called a COLA. And you know, my dad, as an executive at GM, got the same thing that the union workers got. And so did my mom. They all got he would come home and say, oh, I got my extra cost of living bonus this year, and then he would get his merit increases on that. And it meant that you couldn't reduce wages, which later became the case. We actually were able to, we actually reduced wages. You had to reduce workers. And, you know, these kinds of things, I think are, you know, we're shifting and we're not going to go back to the world we were at. That world is gone. There is no turning back the clock.
It's interesting, your comments and just Mike's comments as well, just on the global implications on the commodities and how much we knew beforehand on the impact on our food situation. I don't know if people were really aware of it. I certainly wasn't aware of just how linked it was to Russia and Ukraine. Well, the other thing that, from a talent perspective going on in Ukraine, 1 in 5 of the Fortune 500 uses Ukraine IT services. The United States is 8 times as large as the Ukraine, but produces less than 2 times the number of engineering graduates. So we've got talent implications as a result of the war there. There's short-term issues, certainly on getting work done, but because of the migration of talent outside of Ukraine into neighboring countries like Poland, you could see a shift in the whole makeup of how work gets done there. And in fact, the Hermack Institute, which is part of the Executives Club, we had an event a few weeks back, and there was a speaker on a venture capitalist who was in Poland at the time. And he was telling us real time what was going on, what he was seeing in the talent, mainly women, because men can't leave the country, moving across the border. But that represents a talent movement and shift that we could see in Poland and other neighboring countries. And that's just, it's again, just we wouldn't have predicted any of this.
What is Ukraine doing that's producing so many more engineers than we are?
It's a good question. I think there's a intentionality around this, the education system. You're seeing increased education systems in, I mentioned previously, in Poland, in Mexico, and India. And when you invest in education in that way and you're intentional about that, then your pipeline of talent is built earlier.
So there's grants and money that is driving people to pursue it, both from an education standpoint as well as jobs post-graduation. Before we go, I wanted to go down the line and leave it on something optimistic, not fake, but real, and ask each of you what is one thing, and you can make it as local as you want, specific to Chicago as much as you want, that you feel optimistic about that you're seeing in the economy right now. Diane?
Optimism is in what I see, one, in the demographics. I actually think it's fabulous that Gen Z is so diverse, so I'm really excited about that. But I'm most optimistic by, as hard as this moment in Ukraine is, it unified the world in a way the pandemic couldn't against a common foe, Vladimir Putin. And to see that unity amidst all this dissonance and divisions that we've seen, to me, is one of the most hopeful things I've seen. And it's going to be a paradigm shift for Europe. It's going to do things that are good for Europe, but good for us as well. And those are things that I think are positive in terms of some of the challenges we faced. And it's horrible watching what's going on there. But the fact that it has finally brought us together is really, to me, just important.
And that it's possible for people to
Yes.
make a conclusion and come together.
It's, you know, in this world, I had a briefing with a congressperson this morning, and I had a briefing with someone on the other side of the aisle from that same congressperson, both of them men, white. Not that that matters, but didn't matter. But, you know, they both hate each other. And yet, the conversations I had with both of them overlapped. Mm-hmm. And there was a commonality. And even though they don't like each other, they are trying to work with each other. And that there is some level where you can find that unity in our community. And I'm borrowing that, Jen knows something we talked about at Posse Foundation. That's just magic.
Mike?
Well, you should have had Diane end instead of start. Because, I'm not sure. I'm going to go back to economics, and although I greatly admire your comments there, I'm optimistic that there's really not a lot of structural imbalances that I can point to in the U.S. right now in terms of over-leveraging of businesses, consumers. We have ample savings, although depleting individuals. So individuals are in good shape. So that's back to where we started, which was resiliency. And I think about these previous rate hiking cycles, and this one's different. And they're all unique, but you know, the two that ended the worst, the last four, 99 and 2014, where there was big imbalances, misallocation of capital, over-leveraging in real estate, and we just don't have that today. So I think that gives me confidence that, you know, while we're looking at a slowdown situation here this year, that there is, you know, a lot of resilience for the U.S. and you put into the mix this kind of reshoring effort, and I think the future is bright on the U.S. side.
You raise an interesting point. It's something I recently interviewed the CEO of GM, Mary Barra, and while she, mostly like every other CEO, couldn't say definitively where the economy is heading, when we got into the specifics of her business, in particular on the financing side, she was clear that her customers are not falling behind on their auto payments. And that's the kind of place where you would start to see the cracks show up pretty early if there were cracks in the underlying foundation where the consumer is.
Yeah, and I think that's a great point. I talk to a lot of our commercial clients all the time, and this isn't a build on the individual consumer, but it is to say the same theme. People are very nervous, all this stuff. We talk about these big political issues. You talk about the big sort of recession issues, and then you ask about their business. Oh, business is really good. What do you expect for the industry? Well, it's not going to be as great as last year, but really good. It's like, well, okay, it's sort of a bit of a paradox there at some level. So I'm hearing from our commercial customers are all told, you know, again, from my limited sort of experience talking to a lot of them over time, that feel pretty good about stuff.
Imran?
So I'm optimistic. Over the next 10 years, I think we'll see more people finding purpose in work. And I think the nature of the relationship between the employee and the employer is going to necessitate creating experiences for employees where they can find their own purpose. And to me, when you ask the fundamental question, why do you do what you do? And being able to provide pathways for individuals to achieve that so that they can fulfill their own individual purpose, that to me would be a cause for optimism.
Excellent. Well, we will end it there on the optimistic take. Imran, Diane, Mike, thank you so much. And thanks to all of you.
I wanted to say one more thank you to Rebecca for flying in and to our panel for being here. Before we wrap, I just want to remind everyone of a few upcoming incredible programs we have. We are back to in-person, obviously. So we have a bunch of stuff coming up in May. It's in your program, but I just wanted to run through it really quick. On May 4th, we are honoring Ken Frazier, the Executive Chairman and former CEO of Merck, as our 2022 International Executive of the Year. He's coming to town. He wants to meet people. He's a phenomenal leader. We really hope that you can join us there. Check our website. Then the following week, we welcome Mark Hoplamazian, President and CEO of Hyatt, and Robert Isom, the new CEO of American Airlines, for a conversation on the future of tourism and travel, also in person. And then finally, on May 25th, we're hosting Chicago CEO Gavin Hattersley, President and CEO of Molson Coors Beverage Company, for a conversation on his leadership journey. And it's going to be a happy hour we can drink with him. So that'll be really fun, too. So thanks, everyone. Thanks for being here. Enjoy the rest of your week.